Two teachers, same high school, same paycheck. At the beginning of 2026, both decided it was finally time to invest. They each opened the same investing app, deposited exactly $15,000, and promised themselves they wouldn't touch the money for an entire year. But they made one very different decision. The first teacher chose a classic S&P 500 ETF, believing that owning the biggest companies in America was the safest path to long-term wealth. The second teacher took a different approach. Instead of buying the entire market, he focused on the industries he believed would shape the next decade: artificial intelligence, cybersecurity, energy infrastructure, space technology, and digital assets. Then, something surprising happened. Neither investor traded every week. Neither spent hours staring at stock charts. Neither tried to predict every market move. They simply stayed invested. 12 months later, when they compared their portfolios, the difference was impossible to ignore. It wasn't because one teacher was a financial genius, or because the other made a terrible mistake. The real difference came down to one question that almost every investor eventually faces: should you own the entire market, or should you own the future? That's exactly what we're going to answer in this video. Today, I'll break down some of the fastest-growing investment themes that Wall Street is watching closely, explain why these industries could continue attracting billions of dollars over the next several years, and show you how experienced investors think beyond today's headlines to identify tomorrow's biggest opportunities. This isn't about chasing hype or getting rich overnight. It's about understanding where technology, capital, and innovation are moving, and how those long-term trends can shape your investment decisions. Because in the stock market, the biggest winners often aren't the people who react the fastest. They're the people who recognize major shifts before everyone else does. So, before you buy another stock or ETF, let's explore what could become the next generation of market leaders, and why simply following yesterday's winners may not always be the best strategy for tomorrow. Before we look at specific investment ideas, it's important to understand one simple principle that separates average investors from exceptional ones. Most people invest based on what has already happened. They buy companies after they've dominated the headlines, after the stock has already doubled, and after everyone on social media is talking about it. Professional investors often think differently. Instead of asking, "What's winning today?" they ask, "What trends will still be growing 5 or 10 years from now?" That's where thematic investing comes in. Rather than owning hundreds of companies across every industry, thematic ETFs focus on long-term trends that have the potential to reshape the global economy. And no trend is attracting more attention right now than artificial intelligence. AI is transforming healthcare, finance, manufacturing, transportation, education, and nearly every other major industry. Companies are investing hundreds of billions of dollars into AI infrastructure, advanced chips, cloud computing, and software because they believe this technology will define the next decade of innovation. But here's what many investors miss. The biggest opportunity isn't always picking the one AI company that wins. It's understanding the entire ecosystem that makes AI possible. Every AI model needs powerful semiconductors, massive data centers, high-speed networking equipment, reliable cloud platforms, and enormous amounts of electricity. That means multiple industries can benefit from the same long-term trend. Instead of trying to predict a single winner, many investors choose diversified ETFs that provide exposure to dozens of companies building the future of AI. This approach doesn't eliminate risk, but it reduces the impact of any one company falling behind, while still giving you exposure to one of the most important technological transformations of our time. And once you start thinking in terms of long-term trends instead of short-term headlines, you'll begin to see investment opportunities that most people completely overlook. Artificial intelligence may be leading today's headlines, but it doesn't operate in isolation. Every breakthrough in AI creates demand for industries that most investors rarely think about. Consider what happens every time a new AI model is released. Behind the scenes, thousands of high-performance chips process enormous amounts of data inside massive data centers running 24 hours a day. Those facilities consume huge amounts of electricity, require advanced cooling systems, rely on powerful networking equipment, and must be protected against increasingly sophisticated cyber attacks. In other words, AI isn't just creating winners in software, it's fueling growth across an entire economic ecosystem. That's why experienced investors often look beyond the obvious names and ask a different question. Who is making this revolution possible? Companies building power infrastructure, electrical equipment, cloud networking, semiconductor technology, and cybersecurity solutions could all benefit as AI adoption continues to expand. This is one of the biggest differences between investing based on headlines and investing based on long-term structural trends. Headlines usually focus on one company, while long-term investors focus on the entire supply chain. By understanding how these industries connect, you can build a portfolio that's positioned to benefit from multiple sources of growth instead of relying on a single stock. And that's exactly why our next investment theme deserves just as much attention as artificial intelligence itself, even though it receives far less media coverage. That next investment theme is cybersecurity, and it may be one of the most essential industries of the next decade. As businesses become more connected and AI becomes more powerful, cyber threats are evolving faster than ever. Every company that stores customer data, processes online payments, or operates in the cloud faces the constant risk of cyber attacks. Banks, hospitals, retailers, government agencies, and even small businesses are investing billions of dollars every year to strengthen their digital defenses. Unlike many industries that depend on consumer spending, cybersecurity isn't a luxury, it's a necessity. Companies can't simply stop protecting their networks during an economic slowdown because the cost of a major data breach can be far greater than the cost of prevention. That's why many investors view cybersecurity as a long-term structural growth industry rather than a short-term trend. Instead of trying to predict which single cybersecurity company will dominate the future, some investors prefer diversified ETFs that hold multiple leaders across the sector. This provides exposure to companies developing advanced security software, cloud protection, identity verification, and threat detection technologies. As artificial intelligence continues to expand, the need for stronger digital security is likely to grow alongside it, creating opportunities for businesses that help protect the world's increasingly connected economy. But technology alone isn't enough to power the future. Behind every AI model, cloud platform, and cybersecurity system is something even more fundamental, and that's the massive amount of energy and infrastructure required to keep the digital world running. And that brings us to what could be the most overlooked investment opportunity of this decade: the infrastructure powering the digital economy. Every AI model, every cloud service, every online transaction, and every cybersecurity platform depends on one critical resource: reliable electricity. As data centers continue expanding around the world, demand for power, advanced electrical equipment, cooling technology, and modern grid infrastructure is rising at an unprecedented pace. Many investors focus only on the companies creating AI software, but without the physical infrastructure behind it, none of those innovations can operate. That's why some of the most experienced investors don't just follow the headlines. They study the industries quietly enabling the next wave of technological growth. Of course, no investment is guaranteed to outperform, and every sector goes through periods of volatility. The goal isn't to predict the future with certainty, it's to understand where long-term capital is flowing and why those trends matter. Whether you choose broad market index funds, thematic ETFs, or a combination of both, the most important step is having a strategy you can stick with through market ups and downs. Successful investing isn't about chasing every hot stock or reacting to every headline. It's about identifying durable trends, managing risk, staying patient, and allowing time to do the heavy lifting. Because in the end, the investors who consistently build wealth aren't usually the ones making the most trades, they're the ones making the best long-term decisions. If you found this breakdown helpful, let me know which long-term trend you're most excited about over the next decade. And don't forget to subscribe for more research-driven investing content designed to help you invest with confidence, not emotion.